Good morning. It's a pleasure to be here. I've been at the Incheon airport several times in my life, but this is the first time I've made it out, so it's very exciting for me to be here. So my talk today will have some parallels and overlap with some of the discussions we've seen. I'll focus on some financial alliances, but also go a little bit beyond that. I too am a micro guy. I'm a corporate finance professor, and so when I think about these issues, I think about what's going on in the environment, the shifting business paradigm, what affects the way that business operates, and how financial alliances can affect business. But then beyond, and some of the issues that have already been discussed that I will touch on include Federal Reserve policies, geopolitics, and climate risk. So when I think about companies and business, I think about it in terms of the providers of capital, shareholders, owners. I think about it in terms of the providers of debt capital, lenders, but also the other types of participants in the economy that interact and work with business to produce goods and services. So that's customers, employees, and suppliers. And this is increasingly a stakeholder view of the world that also has been expanding, I think, over the last decade or so to think about the role of business in the community and communities also as stakeholders. Of course, companies, business, investors don't operate in a vacuum. They operate in a context of the culture of the economy that they are operating in, a political environment, capital markets, product markets, markets for labor, and regulation. Okay, so I'm going to speak to, first of all, stakeholders. And I really think that over the last 10 to 15 years in a number of companies and countries where the shareholder primacy view is dominated, we're really starting to morph towards much more of a stakeholder view of business. So 20 years ago, you really heard about issues of climate change, social responsibility. But by 2020, BlackRock CEO Larry Fink, BlackRock being one of the largest investment companies in the world, was talking about creating value not just for shareholders, but also for stakeholders. In his letter to US CEOs in 2023, he was using terms such as conscious capitalism, decarbonization, governance, and social issues. Now, the governance has been on the table for many years in the US, but not so much to focus on climate emissions and social issues. And that focus is permeating companies and countries around the globe. So from a stakeholder perspective, there is much, much more emphasis in many organizations on employees, health and safety, workforce diversity, customers, and product safety. Think about the situation that is going on with Boeing in the US over the recent months. Suppliers and environmental and labor standards across the supply chain. So we've also got an increased focus on the social dynamics of business within the community. You know, what is the role of business in society? What is the effect of business on communities with regard to, say, pollution? What are the links between firms and politicians, and what are the associated implications? So we have this environment, this framework, and in addition, companies, countries are operating in a geopolitical environment. There are financial alliances, trade alliances, political alliances, and other. Okay, so I'm going to talk about some of those. From the Office of the U.S. Trade Representative, some sort of headlines. This is economic and trade agreements between America and China, and Japan, and Korea, and there are many others all around the globe. Biden visited to South Korea not so long ago, and he wrote in the guest book, "Thank you for your hospitality and alliance." So these sorts of issues, these alliances persist, they're global, it's not just the US, Japan, China, there are many around the globe, and increasingly they are a source of pressure on business. So as we start to move beyond financial alliances, let me talk a little bit about the Federal Reserve, interest rates, and the economy. And some of my sentiments here will echo some of the comments from the earlier speakers. So in the COVID world, the Fed dramatically cut rates. So we saw on the graph from Mr. Frank, very low rates, massive quantitative easing. It dramatically spurred the housing market in the US, which is a very important sector driving growth. It ignited inflation. There has been this discussion at the Fed, was this transitory, was this permanent? We're sort of starting to find out now that it's perhaps a little bit more permanent than they had been willing to acknowledge. Post-COVID, we've seen these dramatic interest rate increases. So the current range of the Fed funds, 5 to 5.5%. We've seen quantitative tightening, drawing down of the Fed balance sheet, and they have an intense focus on inflation numbers. I think many in the marketplace have acknowledged that the Fed actions in the US have dramatic spillovers, not just within the US economy, but internationally to product markets, capital markets, and currency markets. And while there were a lot of expectations as to the Fed cutting rates, as recently as April 3rd, the Wall Street Journal was reporting that Fed Chairman Powell was saying there was still room for rate cuts this year. By April 16th, he was dialing back the expectations of those rate cuts. Primarily two reasons: inflation numbers coming in a lot higher than expected, and employment gains in the US economy. So the concern that a number of people have raised is, with this sustained focus on maintaining a high interest rate, is this pushing the US away from a soft landing and potentially into recession? So how does this affect business? Fed actions, when they cut the rates, lower cost of capital for firms, more profit, more investment, that's inflationary. It arguably supports zombie companies, some companies that otherwise would go out of business if they had access to higher priced capital. Rate increases, cost of capital does go up also. There's less profit, less investment, and the support for those zombie companies is going to be eliminated. Again, there are spillover effects to the global economy. Moving beyond the role of the Fed, we've got these geopolitical issues that, again, several of the earlier speakers have mentioned. And the way that I like to think about this is in terms of some of the headlines that we see in the business press in the US and elsewhere. So some of the things we're seeing, China dumping US Treasury securities. As that forces prices down, that's going to force market rates up. Treasury Secretary Yellen has been to visit China to discuss the issue about exports. There's oversupply in China. There are allegations that China is cutting prices and driving exports to other countries. That's a problem for a number of countries around the globe and the companies that operate in those environments. More recently, Biden has called for increased tariffs on Chinese steel and aluminum products. As China is exporting more and more, even Brazil and India, members of the BRIC alliance that are sort of financially sort of working together to support the yuan, are experiencing a backlash. One of China's counters has been a pledge to support the yuan as Asian currencies are coming under pressure. So there are these financial alliances, but there are also fragilities in those alliances and geopolitical tensions. Some other issues that come up with regard to government policy, depending on the country. In the US, there are massive subsidies from the US government for chip manufacturing, more than $70 billion in subsidies. I believe Samsung has received about 6.4 to develop chip manufacturing in the US. But even Japan is spending vast amounts on supporting this industry. Again, from a geopolitical perspective, this has been identified as an issue for many countries as one of national security. The EU is targeting Chinese companies in their dealings with Russia. Tesla, as a result of trouble in the Middle East, has halted production in Germany. And then de-risking China-related supply chains is creating other risks and opportunities for businesses around the globe. So how does this affect business? increased risk, increased cost of capital, increased cost of inputs to production, increased prices for customers. That's going to be inflationary. So what does the Fed do? It doesn't cut rates, it may even raise them. The product dumping, it can lower cost of inputs for some companies and countries. It can lower profits for others. It could drive out certain domestic manufacturing companies from the business environment. Subsidies, lower costs for some firms, but increase competition and lower profits for others. So again, when we're operating in a global environment, this adds to the potential fragility of these financial and trade alliances. The next thing I wanted to speak to a little bit is climate. This is a graph that shows world annual carbon emissions over time. You can see South Korea at the bottom there, Japan, US, China. This next graph is showing above the 0 degree line average temperature changes globally. We're approaching the 2 degree limit, which is being deemed scientifically important as a tipping point for global warming. There are other alliances that are being formed to try and address this issue. So the most familiar that you may have heard of is the Paris Agreement. So this is an agreement that the signatories voluntarily join. The idea is that countries are going to limit global warming to less than 2 degrees Celsius above pre-industrial levels. It's legally a binding agreement on the signatories, and this represents a chart of those countries, regions that are participating. Now, if you looked at this is as of 2021, April. If you looked at this a year prior, the US would be a shade of gray because President Trump had exited the agreement. If we look at this a year from now, it may or may not be the same color. It depends on the outcome of the presidential election. If we look at historical average temperatures, this is from 1986 to 2005. This is the projected level of temperature under a high emission scenario by 2040 to 2060. Let me show you that again. This is historical, this is predicted. If we look at sea level rise, this is a snapshot of sea level in 2020 from NASA, so we're in the 0 to 0.05 meter range. This is their projected under the second highest estimate of global temperatures. The implication of this is that there is a great deal of projected migration associated with climate change, both due to heat and due to sea level rise. So there's by one estimate, 216 million people will be relocating from coastal areas and inland areas where temperatures become basically unlivable. If one thinks now about how countries are going to respond to this, we have the Paris Agreement. This chart is a graph representing OEDC members' changes in climate actions and policies, both the number and the stringency. So the bright green are very stringent, the darker shades on the bottom are low stringency, but as you can see, the trend is increasing over time. This is another chart that captures the trend in the stringency of restrictions on climate policies. So again, how does all of this affect business? So physical or asset risk due to the location, heat, sea level rise. Do companies decide to invest in preventative measures? Do you build dikes and dams in sea level locations, or do you relocate? Irrespective, it implies increased costs for companies and countries. Irrespective, it implies increased risk for the providers of capital. There's also transition risk. So increasingly with agreements like the Paris Agreement, there is a great deal of potential for greenhouse gas emission regulation. Even if this is country or region specific, there can be spillover effects. So for example, Europe is looking to tax the imports from countries where there are loose greenhouse gas regulations. All of this implies increased costs for doing business. So the business response, what do? Do you sell polluting assets? Some companies are doing that. There are some public companies in the US and the UK that instead of holding on to very high polluting assets, they're selling them to private companies. That's fine for the public firm, it lowers their emissions, but it doesn't shift the aggregate level of emissions that are being created. So what does this mean for providers of capital? It means risk. It also means in some sense for proponents of restrictions on greenhouse gas emissions, less transparency, perhaps less ability to regulate. So what do we have? We have business. We have business operating in the context of this broad alliance, broad system of factors, including these financial, trade, and political alliances. It's operating in an environment of interest rate risks, so that actions of the Fed have a ripple effect in the US and beyond. But there's an old saying on Wall Street, you can't fight the Fed. So when the Fed decides on interest rate policies, you have to go along and try to do the best you can. But I'm not sure that the Fed can fight climate risks or the Fed can fight geopolitical risks, particularly as Mr. Frank said, when they don't have a lot of room to move. And all of these risks, even in the context of international alliances that can be fragile, have an impact on business, they have an impact on the providers of capital, and they have an impact on the stakeholders. Thank you.